Good morning, everyone, and thank you for joining us on this murky but improving autumn morning. We look forward to holding some of these events face-to-face again soon and have one in the planning for February next year. But we do appreciate the convenience of online seminars and intending to keep them going too. We're here this morning to think about how we can best manage uncertain times ahead for our pension schemes. Some of us are working with sponsors who are still recovering from the pandemic, and some of us are concerned about the risks of inflation and interest rate hikes. There's lots of innovation in the market these days to be considered on how we can plan around these risks. I'd like to offer a warm welcome to our two guests this morning. Firstly, we have Matt Harrison, who is a director at Cardano Advisory, which until recently you would have known as Lincoln Pensions. Matt will remind us how we can use contingent assets generally, discuss why they have come back into fashion, and share with us his experience on the new and interesting ways in which his clients are using contingent assets. We also have Keith Guthrie, who is the Deputy Chief Investment Officer at Cardano. Keith will discuss the risk of inflation and interest rates to our pension schemes. Talk of when interest rates might rise has been commonplace for the last 10 years or so, but rate rises do really seem to be on the way. Markets are pricing in 2 interest rates later this year, although they're not expecting higher interest rates to sustain for too long. This definitely leaves us in a situation of uncertainty, and Keith will cover this by discussing how we can protect our schemes. Investing to protect against rising inflation is not necessarily a new concept for most, but we are starting to have to consider how to do it in a sustainable manner. A final few housekeeping points before I hand over to the speakers. The slides for today's presentation are available to download from the meeting system, as is a feedback form, and we welcome your comments. Please submit any questions that you have throughout the meeting through the system and as we go through the presentation. Without further ado, I will now hand over to Matt. Thank you.
Thank you, Liz, and good morning, everybody. I'm going to talk a little bit this morning about what I'm terming the re-emergence of contingent assets. They were quite fashionable 5 to 10 years ago, I think, and then for reasons that I'll explain, possibly we saw less innovation in this space, and now again we see them re-emerge. So I will talk us through those dynamics, hopefully, and hopefully stir a few questions from the audience. So to take it from the top then, what is a contingent asset? Well, a contingent asset is any arrangement or mechanism that allows value to flow to the pension scheme when a particular event or scenario occurs. Now, that can be a positive scenario as well as a downside scenario, but today I'm going to focus on downside protections for pension schemes, and that will become clear when I talk about the regulatory backdrop as to why I'm focused on the downsides. Usually they'll be linked to scenarios that either relate to funding or covenant deterioration. In some respects, funding deterioration is easier to define, but where it's covenant linked, we generally find that the contingent protection or the contingent asset is either linked to a general deterioration in the covenant. Query how you measure that in some scenarios, but also it can be related to specific events like M&A activity or change of control. I mean, there's a massive amount of flexibility here, and some of the solutions that I'll talk to later are almost infinitely flexible. But the concept is not new, but we are seeing a resurgence, and I'm just about to, on the next slide, explain why I think that is. And I think there are two drivers. One is where pension schemes are in their journey, and the other is the sort of continuing regulatory drumbeat around these sorts of protections. So if I touch on the first of those themes initially, we are seeing pension schemes moving up this curve. And if I explain what this journey is, we think about the role that the covenant plays in the journey of a pension scheme from being underfunded on a technical provisions to being able to transact with a third party and potentially buy out. We think that journey, Cardano, in 3 phases. The first phase is the affordability phase. You're underfunded on technical provisions. You need cash to meet your statutory funding objective. That has been where most pension schemes have been for the last decade or so, frankly. Most of our clients are talking about cash funding. The focus is on recovery plan, affordability, and equitability of treatment with other stakeholders. That's been the core of the debate around funding valuations, the core of the focus from the pensions regulator, and actually therefore the core of the work that we've been doing for our clients. However, as most people on the call will be aware, the last 12 months in particular have seen funding levels improve quite significantly, and many of the schemes that we work with have actually moved into what we call the sort of second phase of the journey, the visibility phase. This is where you're still reliant on your covenant to underwrite potential investment risk, and you need some affordability if things go wrong from an investment perspective, but you're not asking for cash today. So you're taking a longer term perspective on the covenant in terms of getting to your long-term funding target, which now the regulator is asking you to think seriously about. And then the final phase of the journey, where you still have some covenant reliance, you funded on a long-term funding basis, you're trying to get to your ultimate end point, which maybe is just the passage of time, essentially, in a lot of cases, but you still need a solvent sponsor during that period. So covenant risk continues, but the focus around covenant risk is not so much around can my sponsor afford to pay me money now, it's more around what are the risks over the longer time period, and that the second and third phases of this journey are really coming in now into the sites for trustees, and that leads to a focus on the longer term and the risk over the longer term rather than the near-term cash. Then if I talk about the regulatory context for all of this, I mean, almost everything that the regulator comes up with in recent years has pointed trustees in the direction of protecting for the long term. You know, the annual funding statements, the funding codes talk about the low dependency shortfall that I just talked about. Get yourself to a low risk position. That immediately starts thinking, you know, it's called a long-term funding target. It is a long-term goal, and over a long-term period, your covenant risk is obviously greater than it is over a shorter term period. So we're talking about and thinking about a longer time horizon. Guidance around IRM talks about how do you manage risks? Do you understand the downside scenarios? Are you contingency planning for those downside scenarios? Again, very natural to think about contingent assets and downside protection in the context of that sort of regulatory missive. And then, you know, the funding code, we're expecting to see a regime where there's parameters set for fast track. So if you're within certain parameters, you pass through the gateway. But for those schemes that can't achieve the fast track parameters on funding, investment risk, etc., they will need to demonstrate why it's appropriate for them to take another route. And we think in those scenarios, one of the key things the regulator will be looking for is, you know, are you protecting if you're taking a longer time to reach funding levels, are you protecting the risk over those longer time periods? So again, I think that will drive this sort of thinking. And also I thought I'd mention around sort of a transactional activity. There's a significant focus on Pensions Act 2021 provisions and on ensuring that the scheme is protected in corporate activity, and where there are corporate events, that's leading to a significant increase, I suppose, in the kind of dialogue between trustees and sponsors around those sorts of events. And where a scheme is already funded on a technical provisions basis, the kind of mitigation that they might be seeking in those sorts of scenarios is less likely to be cash related. So in the past, had there been detriment caused by a corporate event, you may well have seen trustees looking for mitigation by way of cash payment. That's less likely to be the appropriate mitigation if you're already funded or well funded on a technical provisions basis. So again, as mitigation for detriment caused by corporate events, we're seeing contingent assets used in that context as well. So lots of drivers for an increase, not just where the pension scheme is in its journey, but also the kind of regulatory backdrop. I'm now going to talk about some of the forms of contingent asset protection that we see. And I'm going to break that into two broad categories. One is using the sponsor's own resources to provide the contingent asset support. That's more traditional, shall we say. And the second is actually using external support to provide the contingent asset. So I call that externalizing the covenant, getting some protection from somewhere outside of your own sponsor group. On this slide, we talk about a number of different ways that you can use your sponsors' financial strength to support the scheme over the longer term. I think there's probably 4 different kinds rather than 5 different kinds of protection here. One is broaden. The first is broaden the access. So parental guarantee is the most obvious form of that, but it might be any form of guarantee from any entity within the group. Now that's fantastic in terms of getting you access to the parts of the group where there's value, but clearly there's correlation between the risk of your sponsor failing and the risk of the wider group failing. The next 2 are really kind of a similar theme, which is it takes a pool of assets and ring fence them, protect them for the scheme in the longer term. Now, is there sufficient value available in terms of the assets that the sponsor has? Is there sufficient liquidity available if it's cash that you're thinking of putting into the protection? That it can be a challenge there, but clearly that's a strong form of protection for the scheme in a downside scenario. The downside commitments, this is, I would say, the most flexible means of downside protection, and it's very bespoke and can be used in sort of any circumstance, really. My word of caution with this is a situation where you identify a trigger event, something that happens in a downside on funding or covenant, which triggers usually a cash payment into the scheme, or maybe some other form of protection to kick in. And you can set that trigger wherever you want, very flexible. But the challenge with that is, if you're seeing covenant deterioration, do you want, is that the right time to be asking the sponsor for cash or equivalent funding? It's great, I think, really helpful for funding deterioration. We're seeing quite a lot of this actually at the moment, where pension funding levels are above TPs, but everyone recognises the prospect that they could fall below, and you can hardwire, and we're seeing a lot of schemes hardwiring, contributions switch back on if funding falls below X level. And I think that's a really good use for that sort of commitment. Less convinced that it's a great one from the perspective of downside covenant events. And then the last one, which was fashionable 5 to 10 years ago, and we're not really seeing make too much of a comeback right now, is the asset-backed funding structure, where you take income generating assets that the sponsor has, you put them in a vehicle, you secure them for the pension scheme, and the pension scheme gets access to that income through deficit repair contributions should it need that. The benefit of that being that you can recognise the entire value of those future cash flows up front as part of your funding calculation, but the downside being that it's expensive to do, it's costly to maintain, and clearly the sponsor needs to have those assets available. So there's different ways that you can broaden your access, get access to specific assets, or set triggers in downside using the sponsor's balance sheet or resources. But I think the more innovative things we're seeing, and the more interesting conversations in many respects that we're seeing at the moment, are around externalising the covenant. So, and the real benefit of externalising the covenant, I think, is that you get a form of covenant diversification when you do this. So some of the cons that I talked about on the previous page are: can the sponsor really pay when there's a downside event? Are the assets that have been pledged to the pension scheme valuable when the sponsor's not solvent or unable to trade on an ongoing basis? Those are real serious questions you need to ask about using the sponsor's balance sheet for protection. But when you externalise, you typically get a counterparty to stand behind the pension obligations, which is well rated bank or insurer, which can be quite positive. So taking this from the top, then you can have a bank stand behind the pension obligations up to a set quantum through a letter of credit. That's fabulous in terms of diversifying the covenant. It's good where the sponsor has significant capacity to on its balance sheet to take on debt, because essentially it is a form of debt, or it's certainly an allocation of a debt facility to the pension scheme. So it can be really good for large sponsors with modest sized pension schemes. Clearly, that is easier to get, as is the one below. It's easier for the sponsor to get where it's well regarded from a credit perspective by the bank. It'll be cheaper, it'll be easier to get. So letter of credit, we're seeing those used more. Insurers can also do a similar thing, which is through a surety bond, which essentially is an insurance product where you pay the insurer a premium and the insurer takes responsibility, or the insurer effectively backs the pension shortfall up to a certain level, or up to a defined point. And that's, again, a means of getting access to a strong or getting access to a payment from a strong counterparty should the downside event occur. Usually the downside event on letters of credit and surety bonds are quite far down the track, so it will tend to be default of the sponsor, which is obviously quite a significant way down the sort of demise curve, as it were. We're also seeing a lot more in terms of external, other more innovative maybe forms of external capital, where you don't necessarily just get access to the insurer or the bank through the means that I've talked about. There are solutions developing now where you can actually get a kind of ring-fence pot of capital to sit behind the pension scheme, so capital-backed journey plan, which is starting to emerge as a potential solution for some schemes where a provider of capital stands that capital behind the scheme, takes the assets of the pension scheme, invests them in a particular way for a particular period of time, and guarantees, in inverted commas, a return on those assets. Obviously, it will take any excess that it makes over that period, and so that's what's in it for them. But from a pension scheme perspective, again, there's another way of potentially getting access to value there that backs the sponsor. And the insured self-sufficiency ISS solution is a similar solution, but using an insurer's balance sheet rather than a separate pool of capital. So these are pretty useful, I think, or can be pretty useful in scenarios where the sponsor is weaker and you're looking for covenant support that the sponsor sort of can't really provide. So you get a bit of diversification, but you also get the kind of support you might need to take a little bit more risk in your portfolio. And then the last one, we're not really seeing much of this, and it would only be applicable in situations where the employer has debt that's traded, but it sort of strikes me that the best hedge against, one of the best hedges against the default of your sponsor is to buy a credit default swap effectively, which allows you to benefit, be paid out when the sponsor defaults. I mean, that will only be applicable in certain scenarios, but I wouldn't be surprised to see that become slightly more prevalent going forward. So I think externalizing the covenant and having real options to do that is a real positive development actually for pension schemes, for the diversification point that I made earlier. I was going to talk briefly here to a case study, a sort of recent situation that I was involved with, which maybe draws some of the strands together. The sponsor here wanted to reduce deficit repair contributions. It had growth plans, development plans, wanted the capital for the business rather than the scheme. The funding of the scheme, as I talked about earlier, had improved quite significantly. We were ahead of plan, so there was some logic in the company's request to reduce deficit repair contributions. There is an existing contingent funding commitment there, which is linked to the leverage of the group, and that will sort of continue to exist. So we do have a form of contingent protection already. We don't have a sponsor that is the entire group. We are in the main trading entity, but down in one corner of the group structure. And so, that's I guess the backdrop to the situation. And the sponsor came with this proposal to say, we'd like to reduce deficit repair contributions. How do you feel about that? That's a tricky one for trustees. Obviously, when you've got an agreed schedule, you are, in this case, not, the sponsor covenant is in the sort of tending to weak zone. So you're not delighted about your long-term prospects of your sponsor. It's quite a difficult ask from a trustee perspective on the face of it. But the sponsor also came with proposals around externalizing the covenant. I think in this case, they were thinking along the lines of a capital-backed journey plan. But the trustees in this case, didn't like the conditions associated with the proposal. Essentially, you tie your money up in a capital backed journey plan. Arguably, the risk profile of the assets within that framework is greater than you would take yourself. Really, is that attractive from a trustee perspective? Well, it could be in certain circumstances, but here I think there was a feeling on the trustee board and on advice from us that actually there was more available within the group that you could go after to protect the downside. You didn't necessarily need to externalise the covenant, and some of the downsides of externalising the covenant, some of those parameters and dynamics that were being proposed weren't that attractive. So we sort of went into a phase of discussion with the sponsor. The sponsor, in fairness, was very receptive to all of this and saw some of the flaws in what they'd proposed. But where we've got to, or where we're getting to, it's sort of live-ish, this situation, is that a kind of a package of measures using some of the tools that I've talked about on the previous pages. So we're looking at a surety bond. So we're looking at some externalisation of the covenant, but not for by any means all of the deficit, for a relatively modest portion of the deficit. In fact, at the moment, it's probably most likely that what we'll try and do with the surety bond is to cover the delta between the contributions we would have got and the contributions that the company's proposing we now get. So there's some sort of downside protection against the embarrassment of reducing contributions. And then this bigger piece around, well, we don't want to be in the subsidiary down in the bottom left-hand corner. Let's get group access. Let's get access to all the value that's here. We might still be an unsecured creditor, but at least we're an unsecured creditor of everything. So that protects us in the downside as well. And also just strengthening the provisions around, well, okay, we're fine to reduce contributions now because we know we're in a good place from a funding perspective. But actually, what happens if that falls back? What's our downside protection there? And that's where as I mentioned earlier, some of these downside contingent frameworks around funding are actually very effective. And that's what we're using here to sort of say, well, if funding falls, we still need the money that you originally were going to pay us, or an element of that money you were originally going to pay us. So we've worked a solution which tries to cover some of the angles, and we think is preferable in this case to the externalisation of the covenant, mainly because of the terms associated with that externalisation. So hopefully that sort of brings together a few of the themes and a few of the solutions that I've mentioned briefly. So just sort of, I guess, bringing it all together, there are existential risks out there around covenant in the long term. We all know about technological change. We all know about climate change. We're talking to our clients a lot about the things that we don't yet understand that will affect their schemes over 20 years. So nobody's got a crystal ball. Nobody can be particularly confident over the 10, 15, 20-year time horizon where covenant risk still exists. So having downside protection, thinking seriously about the scenarios that could affect your sponsor and making sure that you've got the best protection in place that you can is a really great thing to do for members. It's not viable. It's not sensible. It's not what the regulator requires for cash to go into the scheme to cover off all those risks. So you have to have these sorts of protections in place. If you're running long-term risk, I say you have to. I mean, you have to think about having them in place, and you have to get them on the agenda with the sponsor, and you have to try your best, I think, in most cases, to make sure that the protections are there where you need them. So, and the regulator will be delighted with any trustee that's negotiated robust downside protection mechanisms, because it's very consistent, as I mentioned, with all of its guidance and all of its missives. So I think that's the reason, or those are the reasons why we're seeing them come back into fashion, and we're seeing innovation around them, because actually it's very interesting to, I would say, 75% of my clients at least are talking around valuations about these kind of mechanisms, because there's no conversation to be had around cash at the moment. So let's shore up the long term, essentially, in very simple terms. So conscious of time, that was all I wanted to say. I'm very happy to answer questions at the end. I will now hand to Keith. I won't leave the stage until Keith appears, but Keith's going to talk, as he said at the start, around inflation. Here he is. Excellent.
Uh,
Thanks, everyone.
I wonder, Matt, there is one question in the in the chat, which maybe you just want to pick up now before we move on to my section.
Okay. What is that question?
Are we seeing these types of solutions being driven by the trustee or the corporate advisors?
Yes. I think there's a mix. There's a definite mix. So in the case study I talked about a minute ago, the corporate advisors were trying to innovate around solutions, and that triggered the conversation. So I think a lot of the time you are seeing corporate advisors pushing solutions or suggesting solutions. But around funding valuations, I would say it's more a trustee. It's more a trustee consideration, because it's the trustee that's thinking about the journey. It's the trustee that's worrying about covenant risk over the longer term. So I'd say there's a mix, probably mostly around funding valuations. It's trustee driven.
Yeah, great. I think there'll certainly be time for questions later on Matt's section. So if people don't mind, I'm going to move on to my section, and then we can come back to questions on that. So the bit that I wanted to talk about today ties a little bit into what Matt's talking about, is sort of how pension funds think about protecting themselves, and in particular the concerns around inflation, which I'm sure you're all very aware of. You know, a lot of market commentary increasing around this area, and in particular today, what I would like to focus on is how we might construct portfolios, particularly the growth portfolios, because I think many pension funds have already thought about inflation in their liability hedging program, but they may not be thinking through what are the implications of inflation for my growth portfolio. And so I wanted to spend a bit more time on that. Think a little bit through the basic fundamentals of inflation, what's driving it, why the next 10 years might be different to the last 10 years, and what you can do about it in your portfolios, and crucially, how you can do that in a sustainable way, because obviously today, most people are focusing much more on sustainable investing, and there are components of inflation that can be more sustainable or less sustainable. So that's the topic of my conversation here. And I've got quite a few slides to go through, so I'm going to go at a little bit of a pace, if people don't mind. The first thing, just in terms of the definition of inflation, the price of goods in a fiat currency. We're all working in the world of fiat currencies these days. And so inflation, upward inflation, could be driven by a number of different factors. It could be driven by excess demand. It could be driven by insufficient supply. And those would both be in the numerator. It can also be driven by the denominator. So excess money creation of the base currency that we're measuring the inflation in. And today, I think the world is very focused on insufficient supply and sort of all the shortages in the world that are driving up inflation in the short term. Longer term, I think excess demand might be more of an issue, and money creation is certainly something to be talking about, because this is something, you know, the monetarist would say to you, all inflation is a function of money. However, where I think maybe people need to focus more on is it's not just base money. It's not only M0. It's also money creation through credit and the banking system. And so what's the total money being created in the system? And so a lot of people have questions why we didn't see inflation over the last 10 years because of QE. That created a lot of more base money in the system, but didn't necessarily lead to total money expansion, as particularly consumers deleverage their balance sheets. Is that about to change over the next 10 years? So in the short term, we are certainly seeing a lot of signs for the first time in 20 years of increased inflationary pressures. And on this slide, I've got in the top right-hand corner, just the US CPI. So the blue line in the middle is the US CPI print, and you can see that's shot up to about 5%. The two lines around it are, the orange line is at the top for most of the period, and at the bottom at the moment is services inflation. And the green line at the bottom is goods inflation. And you can see how goods inflation has really taken off, very much driven by some of those supply constraints that we've been talking about. And so there are supply constraints everywhere we look at the moment, whether it's in microchips, secondhand cars, labour shortages, as we've seen here in the UK with the fuel supplies, but also we're seeing this globally. It's not a uniquely UK phenomena. We're seeing it in the US, in Europe. So lots of areas where inflation is being squeezed up at the moment. And the hope of central banks is that this is a very temporary squeeze up in inflation, that as supply chains normalize, the labour situation normalizes, all of this will come back and inflation will continue like it has in the last 20 years, be a very deflationary sort of environment. And we think there are quite a few reasons why that might not be the case very quickly. So certainly we're seeing this ongoing squeeze in oil prices and natural gas prices, which is pushing commodities up further than people had probably anticipated. One of the things that we think will feed through to more inflation next year is shelter inflation. It tends to be a bit slower to come into inflation numbers, but we think that will continue to keep inflation elevated going into next year. But I'd very much still describe that as the short term. So the real question for me of the next 10 years is what's going to happen to the underlying drivers of inflation and what might be different over the next 10 years to what we've had in the past 10 years. And there are many different factors that I think are going to be different. So, for example, global labor supply is something that we said, in the early 2000s, the shock of China joining the the WTO, and the supply of new labor coming on from emerging markets really created this excess supply of labor, keeping wages very depressed and allowing this deflationary environment. We don't think that that's going to be repeated in the next 10 years. And I'm not going to go through all these others, but there are three that I would like to just highlight, which I think are important to be thinking about the current context. The first is the overall levels of debt. And that is because in the context of a world where governments have had to take on a lot of debt through this COVID crisis, there is a very significant incentive for governments to be thinking about more inflationary policies to inflate their way out of that debt situation. And this is not unprecedented. In the 1940s and 50s, we had very strong, very high debt levels post-World War II. And what you had at that point in time is very robust growth, but at the same time, central banks actually targeting yield curves, controlling how much yield curves could sell off in order to create higher nominal growth than the interest rates that they were paying on their debt. And that allowed them very successfully over quite a number of years to deleverage their economy. But ultimately, it was inflationary as we got into the 1960s and then the 70s. And the question is whether we sort of start to see a little bit of a replay of that kind of situation, because governments have tried the restructuring route as they did in Europe in the 2011, and that really is very deflationary, and that's the big fear that they have at the moment. The second thing I would highlight is that monetary and fiscal policy coordination is different to what we had in the 2010s. So in the 2010s, we had a lot of monetary stimulation going through QE. The mechanism there is very indirect. It's basically governments create money, buy government debt. They hope that the owners of that government debt buy something more risky, and that somewhere along the line, a riskier investor that makes people feel more wealthy as the wealth effect goes through and those risky assets go up in price. And then that creates a spending effect because people feel wealthier. That's a very indirect mechanism to create spending. Fiscal coordination, which is what we're seeing today, together with monetary policy, so monetary printing in order to be able to fund fiscal policy, which is where governments around the world are today, is much more directly inflationary, because that fiscal policy is going direct spending on infrastructure, on putting money directly in people's pockets through financial support, and that is much more directly inflationary. And then the final one, which I don't think many people are thinking on at the moment, at least not in an inflationary context, is the green transition. And I'm going to spend a little bit more time on that later on, but we really think that there's going to be an excessive amount of demand created for certain commodities and labor through that green transition, and that itself could also be inflationary. I won't touch on more on these. I'm happy to come back on questions on that later. So what are the market implications of this these sort of longer term drivers. And certainly we think that one of those market implications is higher inflation than we've been used to over the last decade. We think that that is accompanied by higher nominal growth. The question really is whether or not that is higher real growth or lower real growth. So how much of that is inflationary growth versus what is actually real growth in the markets. And there are quite a few market implications to be thinking of. The first one is we do think on yield curves. So yield curves, we do think are going to be under pressure to move upwards in this sort of environment. Interest rate increases are already starting to be anticipated by the markets. Certainly yield curve steepening is something that we would be expecting in this kind of environment. But there's a very big question in a very over-indebted environment of how much consumers and other borrowers can actually bear in terms of increases in interest rates. That will then have implications for equity markets. We think there are big implications for commodities, and then for inflation-linked bond markets and break-even inflation, which I'll get to in more detail in the next little while. There'll be important market implications. Now, why is that important to your portfolio? So the key risk, we think, is that rising interest rates creates a real danger for your growth portfolios. And at the moment, the gap between where inflation is, which is in the top right-hand corner, the blue line, and where interest rates are, even though interest rates are starting to increase, that gap is at tremendously wide levels. So very negative real interest rates at the moment, which continue to be stimulative of this economy. And at the same time, we've got very high equity valuations. And that's probably been for good reasons, strong economic growth expected, but also because interest rates have been so compressed, the discount rate of all of those future cash flows is allowing equity valuations to be very high. So one of the key pillars that those equity valuations are built on at the moment is low interest rates. And if that starts to change, we could have a very different impact in the portfolios. And so for growth portfolios in particular, I know many pension funds have the liability hedging in place already, but for a growth portfolio, this kind of setup is not ideal. And the key question is, what can you do in your growth portfolio to really create a bit more of a diversity and a buffer against the kind of environment that might be bad for both equities and bonds in your portfolio? And our answer would be, consider putting more inflation-sensitive assets into the growth portfolio. And so we'll talk a little bit about how that might be achieved. The first thing is just to say, is there a historical proof that this is a good idea? And what I'm illustrating on this page is the 10 worst periods for government bonds over the last 100 years. And that's the top line, sort of the performance of government bonds at that point in time. You can see on the second line that equities are not really predictable in that kind of environment. In many of those rising interest rate environments, equities do very poorly. In others, they can do well. And a key differentiator there is what's happening with inflation. And so what I've done on the third line here is sort of talk about inflation, a group of inflation assets, which we'll get onto speaking about in more detail, what might be in that basket, but how those inflation assets did in those particular years. And what you can really see is that the consistent picture is that inflation-sensitive assets do well when those government bonds are doing poorly and can really be diversifying in a portfolio in combination with equities. So from first principles, what kind of assets might you think about including in a growth portfolio? And then crucially, which of those are sustainable? So the first ones I would highlight are break-even inflation contracts. And for those, I'm hoping many are familiar with it, but inflation-linked bonds have a component of inflation in them. So they rise with inflation over time, but they also have a very big interest rate sensitivity. So the reason that I focus on inflation break-evens is that these do not have the interest rate sensitivity. They're pure expressions of the sensitivity to inflation. So how does a break-even inflation swap work? We would enter into a contract, a counterparty with a pension fund, and if inflation over the next 10 years is higher than a fixed rate on that contract, then the pension fund would be paid out for that higher inflation, and if it's lower, then the pension fund would pay the counterparty. And so it's a very direct linkage to inflation over a period of time. Another traditional asset that many people think of as an inflation asset is gold. When you look at gold, it actually looks, we agree that it is an inflation asset, but only in extreme scenarios. Gold is an asset that people go to when they fear either extreme deflation or extreme inflation, and particularly stagflation. So when they no longer trust the financial system, gold can be a very good diversifier to portfolios. Many people talk about crypto these days. That's not something we would recommend if you haven't already got a decent bit of gold in your portfolio, and I think it's a much more speculative market. And then there's commodities and various types of commodities that could potentially be brought into the portfolio. The most direct linkages we'll speak about in more detail are probably in the fossil fuel space, but of course that has sustainability implications. Real assets, land, buildings, infrastructure, timber, forestry, we think these are very sensible allocations, and a number of pension funds already have good allocations here, so we'd be recommending considering thinking about those type of assets as well. And because they're quite familiar to most pension funds, I'm not going to spend too much time on them in the remainder of the presentation. So I want to just talk through the case for, number one, increasing your inflation exposure through commodities and through break-evens. And first of all, the case for commodities. What's the fundamental case? Well, the very starting point is that there's a very big portion of inflation indices that are actually directly sensitive to commodities. So in these graphs, these are graphs of inflation in the US, Europe, and UK, the baskets that make up those inflations, and linkages to direct commodities down at the bottom, all the way through to indirect linkages to commodity sensitivity. You can see that the US probably has relatively low sensitivity to commodities. Europe actually has quite high sensitivity, as does the UK. And if you went to emerging markets, you'd have even higher sensitivities here. And so when you're thinking about a global portfolio, you really want global protection against inflation in all sorts of different markets. Commodities, we think, make a lot of sense. The next question is, well, what kind of commodities might you have exposure to? And sorry, this is quite a busy slide, so I'll just explain a little bit of what's going on here. We've got the various types of commodities you might have exposure to. So energy commodities would be your oils, your natural gases. Agricultural commodities, industrial metals, that would be copper, zinc, precious metals, gold, platinum, and then livestock. And the first question is, what is their linkage to inflation? And certainly energy, we have very direct high linkages. But in many of the others, still a medium linkage to inflation. The second question is, well, how sustainable are those commodities? And in particular, we think of the fossil fuels as the least sustainable commodities, probably along with livestock, where these both have the biggest impacts in underlying carbon impact. Others definitely still have very big sustainability impacts, but will be very necessary and continue to be necessary for the world. And we need to figure out how to produce them in more sustainable ways. So those would say are the areas probably to be focused on more from a sustainability perspective. And then taking you to the bottom table, what we're illustrating here is the sensitivity between commodities and different markets. So in the first column, we have the sensitivity between commodities and US CPI. And you can see that there's this very direct linkage to energy sensitivity and very low sensitivity to the others. The second column illustrates the linkage between those commodities and the world equity index. And so you can see that, for example, industrial metals, they've got quite low correlation to the world index, but they are positively correlated. Most of the rest are quite diversifying from an equity portfolio. And in the final column, we actually look at the linkage between commodities and 10-year break-even, so the market expectations of inflation over 10 years. And then the really interesting piece is that the strongest linkage is actually through industrial metals. And so we think that really can form an interesting component of a portfolio that can be very diversifying to protect against inflation, though it does have a bit more of a linkage through to growth. So you need to be conscious of the correlation there in a portfolio. Now, there's another reason why we think industrial metals make particular sense in today's environment for the inflation linkages. And we think that is particularly around the climate opportunity. So as we go through this transition towards a green economy over the next 10 years, it's going to be the largest transition we've seen in our lifetimes in the way the economy is functioning. And over here, I've just illustrated two things. On the left-hand side, the amount of investment that is going to be needed globally in order to do this transition. And at the moment, we're at about $2.5 trillion investment in energy infrastructure per year that the world is doing. And that needs to rise, according to the IEA's estimates, to about $5 trillion a year of new commodity investment. And we think that that's a very substantial driver of demand for a number of things, labor, technology to be able to do these things, but also particularly for commodities, and in particular for base metal commodities. So in order to electrify much of the world, we'll need a lot more copper, as an example. The average electrical vehicle takes about 8 or 9 times the amount of copper as a diesel or petrol vehicle. All the wind turbines need an awful lot of copper in those turbines. So there's an awful lot of base metals that are needed for batteries, for the various pieces of infrastructure that need to be put in place in order to electrify the world in a greener way. And so we think that commodity demand maybe goes up by 5 times in these sort of areas over the next 30 years. And that's going to create a tremendous tailwind in demand for commodities and require higher prices to really create the ability to produce these in a sustainable way. The other newer area in the commodity space, and I apologize for the very dark graph here, is actually being able to directly trade carbon as a commodity. And over here, we would talk particularly to the carbon trading schemes that are in place. They're in place in California, in the European Union and the UK. And for example, China is now developing and has just recently launched a carbon trading market. And so this is really directly saying, what is the price of a ton of carbon emitted into the atmosphere? And that price today is at around $60. It's increased dramatically over the last 6 months. 60 euros, sorry. And when you talk to climate change scientists and economists about what they think carbon prices have to get to in order to incentivize the transition, we're really talking about prices maybe $100 in today's world, and by 2030, maybe $300, $500 per ton of carbon in order to properly incentivize changes to climate change. And so that's also a potentially new commodity that could be included in portfolios. And we're doing a lot of research on whether or not this can be added to portfolios and be diversifying. Finally, I just wanted to come back to break-evens. And so over here, we've just illustrated the price of those 10-year break-even inflation swaps that I was referring to earlier on. At the bottom, you have European break-evens. The blue line in the middle is US break-evens, and the green line at the top is UK break-evens. So at the moment, UK break-evens, and this is slightly out of date, they're about 4.2% today. So that would mean that the UK break-even market is predicting that UK inflation could be as high as 4.2% for 10 years running. Now, that looks to us, even though we think there's going to be a more inflationary environment, like quite an extreme prediction. It may well end up being true, so the market is certainly concerned about inflation. But for us, UK inflation does look expensive. If it's part of your liabilities, the hedge is sensible. And in a growth portfolio, we wouldn't be thinking about UK inflation at this point in time. But certainly both US and European inflation do not look like they are predicting very high levels of inflation over the next 10 years. And would be sensible diversifiers to include in a portfolio. So in summary, what we'd be thinking of to add to growth portfolios is some exposure to commodities. A question here of how big. We would say maybe 10% of a portfolio would be a sensible portion of a growth portfolio to be allocating across gold, base metals, and carbon, and then also some exposure to break-evens. And with that, I'm going to end.
Okay, thank you very much, both. There's definitely a lot for us to think about. So we don't have a hard finish, so there's still time for some questions. So just type them into the box if you have anything that you want particularly to ask. And we'll just start with one from Matt. Could you give us your views on the extent to which contingent assets can be used as a replacement for cash?
Liz. I think kind of quite a long held and understood trade-off between cash and protection. I think the basis on which asset-backed funding structures and things like that were initially put forward 10, 12 years ago was very much, if we give you more protection and support, you can take longer for your recovery plan. And I also think that the bespoke regime that the pensions regulator is talking about kind of recognises to an extent that if you have good long-term protection, you can take longer to reach your funding objectives. So I think you can. I mean, clearly you need to still have a credible recovery plan, but I think you can take longer. The other scenario where I think contingent protection can be used instead of cash is where you've got a statutory debt triggering in one of your employers or something that may, in the normal course that would be paid to the scheme. I've certainly seen circumstances where pension schemes have negotiated downside protection rather than collecting that debt. So I think there are definitely circumstances where contingent protection can be a replacement for cash.
Okay, thank you. Can I also ask you, in terms of as the new kind of regime comes in, and one of the kind of issues with kind of bespoke situations is that the regulator will need to spend more time on them. Now we're kind of used to hearing how busy the regulator is and how these things can be tricky. Do you think that will make it easier or harder to work with these situations?
The challenges the regulator's facing at the moment is where do you draw your line for, or where do you set your parameters for fast track? If you get those too stringent, then everybody will be in bespoke, and the regulator will certainly struggle to deal with that. If they're too loose, then are they effectively regulating? So I think there's a question mark about where the lines will be drawn. Do I think you're more like? I mean, the regulator is saying that bespoke is not a bad outcome; it's just a different outcome. And if you can robustly document you've had a governance process where you've thought through why you've done what you've done and you're comfortable as trustees, then I think the regulator will be pragmatic. So I wouldn't say it will be more difficult. Particularly, but I think that you'll need a good governance trail and a good sort of logic for that part.
Okay, thank you. I have another one come through from you. So can you tell us how easily you think that sponsors with weaker covenants can provide contingent assets?
It's more difficult for sponsors with weaker covenants. I mean, this is why the regulator's mantra of fix the roof while the sun shines definitely holds here. It's much easier to get assets that aren't pledged to banks. It's much easier to get insurers and banks and other external counterparties to provide protection where you are a strong credit. So it's easier to put these things in place where you have a good covenant. And I think a lot of the scenarios we're seeing now is a recognition of that. When you're already a weaker covenant, it becomes more difficult. You're into usually very challenging negotiations with other stakeholders, particularly banks, around how you carve up the value. And so, you're into more of a game of what cash can we get more quickly here? What share of the assets can we negotiate? So definitely Andy's, onto something there. It's harder when you've got a weak covenant. So I would encourage those that think they've got a stronger covenant to think now about protecting the long-term risk.
Okay, thank you. I've got one for Keith. So obviously we've heard about increasing inflation for some time. What makes it different this time, and how convinced are you that it really is an issue on this occasion?
Yeah, so I think I touched on some of the things that I think make it potentially make it more likely that we will see inflation. I think if you were to argue the counter argument, what will stay the same? There are possibly two things. One would be automation. And so, the sort of fears of automation essentially crowding out labor and creating continued deflationary pressures, I think those are real and substantive. Higher labor prices, higher oil prices are going to incentivize continued moves in that direction. Though, as I was talking about the green revolution, I think not all installation of solar panels can be automated. You're going to need labour to be doing these things. So I think that automation is definitely one of the negative pressures on inflation. The other one, which I think there are different views on these days, is demographics. And so many people point to the Japan situation and say, well, as populations age, you get very deflationary type of environments. But there have been some interesting papers out recently that actually point to potentially the opposite and say that the Japanese situation is misunderstood, and that actually, as your population, as you have more dependency, your dependency ratios increase, with old age populations dependent on a smaller tax base, that creates inflationary pressures. So I think those are the kind of questions which might be different, but many of the other factors I think have flipped around in the last from the last 10 years and actually now pointing towards inflation.
Okay, and can I also ask another question about ESG, which is partly related on what you're talking today, but we know you've been doing a lot of work on ESG. So, as trustees, we really want to do our best to make sure that we're doing the right thing, but it's tricky kind of market to navigate. And what's your advice to people in that situation, just to try and avoid greenwashing?
Yeah, so I think for me, one of the key things that people can really think about here is separating out the idea of their exposures and their risk from their influence and their impact. And the thing that we really want to maximize is our influence and our impact. We want to make sure that we are, wherever we can, influencing companies, governments, consumers to move in this direction of going towards net zero. So transformation of the real economy. And we can do that through good stewardship, through thinking about what kind of investments we can make that it can actually make an impact. And I think that by doing that, you really avoid the risks of greenwashing. I think one of the challenges is, for example, many people are going to be saying, well, my portfolio is net zero. That doesn't necessarily mean you've created a really good real world impact, because that's quite possible by selling all of your oil stocks or something like that. That might not be the right thing to do from a risk or an inflation perspective in the portfolio in the short term. In the long term, almost certainly, we won't end up owning a lot of oil stocks. But as you've seen recently, that can actually be a very dangerous position not to have some exposure to that when you have a massive run in the oil price. The longer term question is, how do we change those oil companies into more green businesses? And that's why I think the focus on influence is the important piece to focus on for trustees.
Okay, thank you. I think we will. We've gone slightly over time, so we will leave it at that, unless either of the speakers have any finishing words. But no, thank you very much for your time today, to our speakers and to everyone who's attended. And we hope to see you all soon. So thank you.
Thank you.